Hey guys, in today's video I'm going to be talking about mortgages, what it is, and also the components that make up a mortgage. A mortgage is basically a loan that is secured against your property, so your home, and you make your payments at an agreed upon time with your lender and life goes on. However, if you should default on your mortgage, which means you're not making your payments, you're missing payments, or you're constantly late with your payments, the bank can intervene and sell the property and basically take back their money. The components of a mortgage are the interest rate, the term, the amortization, and the payment frequency. I'll discuss the term and the amortization first, just because people tend to get those two confused. So the amortization is the entire length of time that it will take for you to pay off your mortgage. If the down payment that you're making on a property is less than 20%, then the maximum amortization period you'll get is 25 years, which means at the end of 25 years, you would have pay your mortgage in full and your balance would be zero. So you own your property free and clear at the end of 25 years. However, if you are making 20% or more down payment on your property, then you get an extra 5 years. So the maximum amortization period at that time would be 30 years. So you're able to spread out your payment for a longer period of time, which means your payments will be lower, but also you're paying more interest. The next part of your mortgage is the term. So think of the term as like mini contracts between you and your lender. A term typically range from 1 year, 3 year, 5 years. However, on average, people will choose a 5-year term for their mortgage. So you're locked in with your lender for that 5 years at an interest rate that you're paying your mortgage. The important thing is, within that 5 years, you are not expected to pay off your mortgage during that 5 years. The amortization is when you are expected to pay your mortgage in full. But this 5 years is just for that period of time with your lender. At the end of the 5 years, you can renegotiate terms with that same lender, or you can shop around for a different lender who is probably going to offer you a lower interest rate. Your interest rate is the next component of your mortgage. The interest rate is determined on certain factors, but the most important factor is your credit score. If you have a high credit score, chances are you're gonna get a lower interest rate. And if your credit score is low, then you will be paying a higher interest rate. The two types of interest rates are fixed interest rate and variable interest rate. A fixed interest rate is a rate or a percentage that is locked in for that 5 years. So in that 5 years, you're paying that same rate until the end of the 5 years. Whereas a variable rate, it fluctuates. The variable rate is the prime rate minus a certain percent by your lender. Some lenders will use the Bank of Canada's prime rate as their benchmark. Other banks will set their own rate. I believe the Bank of Canada rate now is 3.95. So we'll use that as our example. So let's say you go to your lender, they're going to take that 3.95 prime rate and they're gonna subtract a percentage from it. So let's say they're gonna subtract 1% from that. So now your interest rate is 2.95%. The reason I say that it fluctuates is the Bank of Canada can change the prime rate. So let's say 6 months down the road, the prime rate is now 3.85%. So then your new interest rate is going to be 3.85 minus 1% for a result of 2.85. So that's how the variable rate fluctuates during the term of your mortgage. The last component is the frequency of your payments. You can choose whatever frequency that works for you. You can choose monthly, bi-weekly, weekly. It all depends on your situation. However, if you would choose like a bi-weekly payments, you're paying 2 extra payments throughout the years. The more frequent you pay your mortgage, the less time it will take to pay off your mortgage. So for example, as I was saying, the bi-weekly, that's 2 extra payments. If your amortization schedule is, let's say, 30 years, if you're paying more frequently, that can knock years off of your amortization schedule. So you might want to think of paying your mortgage payments more frequently. I believe that is all for now. If you have any further questions or concerns, or just unsure about any aspect of the mortgage, then you can always give me a call or send me an email and I'd be happy to help you with that. I hope this video was helpful, guys. Have a great day. Bye.